Welcome to the Midweek Market Update, where I do a technical analysis and give you my thoughts on SPY the Qs and IWM. Today I've also got 4 trade ideas for you at the end of the video, so stay tuned. So my goodness, what an absolutely nasty day across the market. You can see almost everything on our watch list was down over 2%. And whenever something like this tends to happen, I like to zoom out on the S&Ps and sort of give myself a little bit of perspective here on what's happening from a, again, weekly time frame, weekly perspective. And if we check in on this chart, you'll notice it's really not that bad. And again, this is from a weekly perspective. I'm not discounting what happened from a day-to-day perspective, but from a longer time frame, longer time horizon, we haven't gotten into this trend line. We haven't gotten into this trend line, right? You could even draw something like this, and this is the steepest probably of all the trend lines we have on the chart, right? And we're just barely starting to break that one to the downside. So as the chart sits from a weekly perspective, I want to be abundantly clear here, weekly perspective, it's not the end of the world. Now, could this be the start of a bear market? Sure. At any point in time could be the start of a bear market, but as the weekly chart sits right now, I don't think that's the case, right? What I would need to see before I would even start thinking about that is a lower high, so something to form in there, and then a clear lower low, right? So there's your lower high, and your lower low would be underneath whatever happens here. And obviously, as the chart sits right now, we just made a fresh all-time high. We're pulling back a little bit. The market needs a little bit of give and take to remain healthy. It can't just continue upward and onward forever and do something like this, although I'm sure we all wish it could, right? So that's my thoughts on the weekly time frame. The last thing I'll leave you with here is we're now well within striking distance of that weekly 20 SMA, which we've talked about in the weekly watch list videos for about 2 or 3 weeks now, right? So we finally pulled in, gotten closer to that visual reference point. Again, not trying to say that we call the top. As you know, we don't tend to do that. We just say, all right, up here is not an ideal location for new longs in long-term accounts, and even on an intraday basis. You got to be very careful when you start getting overextended from some of these reference points, and now we've moved a little bit closer, all right? So let's move back down to the daily. Of course, you're here probably for intraday levels, what may happen into the end of the week, so let's discuss that now. Again, I'm not trying to discredit what happened so far in this week of trade. Let's talk about technical breaks that have essentially occurred, right? We had a daily bull flag that we outlined in the weekly watch list, something like this, and it looked like we were going to go, right? We had a strong close on Friday up and to the outside, but as the chart now lies, we can see we had a look above and fail into the range, came exactly to where we should have came, that 410.50 mark. You know, when we look above and fail, you always target the bottom end, and that was the target, and monitor for continuation from then. Obviously, since that's happened, we've now broken that daily trend line, support trend line here, and as we know, when you break down or out of balance, basically you look to double that balance, and boom, there you go. We've essentially done that in a single day's worth of trading. So as the chart sits right now, we're monitoring for continuation now that we've clearly violated and seen strong momentum to the downside. And again, we'll talk about this in just a moment. Strong degrees of correlation across our sectors. I don't necessarily think it's all just going to end. It's not just going to turn on a dime here at the 50. Now it could. Again, that would be the next technical area that we should just talk about right now is the 50 SMA. If we see a dead cat bounce, what I want you to keep in mind is, okay, how far now do we potentially retrace into the prior day's range? Do we go to the 50% mark, the half back, or do we do something like this? Split this candle into thirds, right? Do we remain in the lower third? That would probably be a bearish outcome. You consolidate down here, it probably goes lower, right? In which case, you're looking for a flush under the 50 to potentially fill this gap underneath, 403.40 down to about $400.67. After that, our prior high from in here will be the next support around 398 the whole dollar. If we go higher, right, and maybe we accept in that upper third of this candle, do something like this, you're just looking at a back test essentially of that 410.50, which was the key flush point. At that point in time, I would be looking for anything like this to form, right? Inverted hammer, and then you look for a pullback to potentially form a daily bear flag, something like this. Can you see how these scenarios start to play out as you just keep your mind open and not necessarily get cemented into thinking, okay, the market's crashed so far 3 days, we have to go lower, the market's going to zero, okay? Don't think like that. Think in terms of potential scenarios. That way you're always on, in theory, the right side of the trade, okay? So those are the few things that I'm watching out for here in the S&Ps into the end of the week. Let's check in on those sectors as we always do, who was leading, who was losing, and where was the weight. Well, leading the pack today, we had energy, and energy, as we know, not a huge important section of the S&Ps, so it's no big deal that they were up 0.5%, whereas everything else on our list here was down right around 1% or greater, right? Barring the XLV, 0.94, right? So XLY, consumer discretionary, leading to the downside there, minus 3.4% just about. That's going to be a decent chunk of the S&P. It's not top 3 chunk, but it's still a decent chunk. It's up there. I don't know the exact figure. As we know, XLK, the tech sector, the heaviest weighted sector, feeling some pain there today, down about 2.8. XLF, second heaviest weighted sector after them, down 1, and XLV for healthcare down 1 just about as well. Let's check in on some of these charts, right? If we just come to the XLK and take a look, obviously the key break here was the 50 SMA. The thing you want to watch out for on a chart like this, and we'll talk about it in more detail on the Qs, is what happens when we come back down into that 129 mark, which was, if you remember this pattern from a number of weeks ago, months ago at this point, inverted head and shoulders, right? This was the shoulder area. That's what you want to watch out for, 129. If we see a red day on Thursday, get into it on Friday, do we see a buy-up reaction at that prior area of support? So 129, critical to watch in the XLK. If we get the bounce, again, maybe that proves that the S&Ps see a little bit of relief into the end of the week instead of continuing to sell off. Next up, we have the XLF, second heaviest weighted sector. And what you'll notice about this is that the pullback is not nearly as substantial as what we've seen in the XLK. So there's two things you can say. You can say, okay, the pullback hasn't been that bad. The XLF could be the potential saving grace for the S&P 500s, in which case it just needs to set a new higher low and then continue on its daily uptrend. So if you think about this, here's a low set, here's a low set. You could argue that this is a low set. Let's say that basically the XLF needs to bottom out and form a higher set of lows at that 20 SMA. That would be somewhere around 36.15. If it does that, great, can continue on the daily uptrend there. It saves the day. If that does not happen, then the other way to look at it essentially, right, is that there's more room for this to fall as opposed, to sort of catch up with rather that XLK tech sector. And we'll talk about this as we get into our first trade idea in just a moment down the line. But as there's more room to fall, the critical area to watch out for on this would simply be to come back down and potentially violate our last major set of higher lows. If that happens, then again, just like we talked about from the weekly perspective on SPY, okay, we do something like this, much greater chance of setting a lower high and potentially violating this to now form some new lower lows. Okay, that would set off a downtrend in the XLF, but as it sits right now, again, I think the more likely scenario is that it holds on to some sort of trend line that would look like this. So maybe bottoming out here around that 36, we'll ultimately have to see, but keeping a close eye on the XLF, and then finally the XLV for the third heaviest weighted sector, clear look above and fail, just like we saw in the marketplace here, look above, fail back down, and I would say at this point in time, very likely to go to 121 with some strong sell side candles, right? Large upper wicks, large red bodies. I don't see why it wouldn't come down to 121 to fulfill the entire range rotation. After that, your critical area to watch is going to be right around here. Prior breakout point just under that 119. You can see it was a prior high, and boom, this is where the ultimate breakout started from, right in this area. So XLV looking for that area to provide support if there's a massive flush under 121, but 121 probably likely into the end of the week. Let's move over to something like the TNX for the 10-year note. And of course, this is going to pair nicely with talks of inflation. And what did we say in last week's video? People will probably start caring about the rates as we break out of this box. And where are we? Right at the top of the box. So as rates sort of increase to try and curb inflation, again, I'm not really much of a fundamentalist, but as I understand it, they will raise rates to try to keep inflation under control, right? And that seems to be what's happening. So as it continues higher, again, you're just looking for a move up here. What would that be? Right around 17, just about 1765 to come back into these recent highs. And again, I think inflation talks, as that comes into the headlines, you'll start to hear more about the 10-year rate. But as it sits right now, definitely sort of threatening, like it's more obvious, right, that inflation could be a thing if they're trying to raise rates here, which obviously doesn't really bode well for the market. So just keep that in the back of your mind. Again, not much of a fundamentalist, but thought I'd point it out. And then lastly, we'll go over to the VIX for volatility. And I think this is the big sort of thing shouting in my face in telling me essentially how to trade into this upcoming event of volatility. What did we talk about? 2050 was the critical mark. What did we close above on Tuesday? 2050 was the critical mark. How did we close today? Obviously much higher than what we saw in Tuesday's trading session. So as it sits right now, volatility is definitely back in this marketplace and something you need to be prepared for. All it means is to essentially increase, say your entry is here, If typically you say, okay, I'm going to take profit up here, so TP for here, and I'll put my stop loss here. All right, now that volatility has increased, your entry is still going to be here. Your stop loss now may need to come all the way down to here, so S1, and your take profit may need to move to like up here, okay? So just be aware of this increase in volatility. The ranges are likely going to be larger into the end of the week as volatility remains high. One thing I do want to point out here is if we go over to VVIX, the volatility of the volatility index, this to me is the most telling, right? We have this 150 read here. It's only happened a handful of times, whereas the VIX, the VIX, right, has been over 20 and a half a number of times. The VVIX, the volatility of the volatility index, has only been, a handful of times over that 150 mark, and that's what we've experienced today. So definitely be prepared for some larger moves to start taking place in this market. All right, so that's going to wrap up sort of our look at the internals. We discussed some of our SPY levels. Let's break it down on the internal screen. If we go over, and actually if you're not familiar with this, get familiar. We talk about it every week. Top right hand corner, we'll talk about what this is, what it all means, and how you can set it up. But for now, if you're already familiar, look at this volume read here, absolutely impressive to the downside, over 500 million, whereas we usually use that minus 300 million or plus 300 million as a benchmark. Clearly we violated that to the downside, so strong outflow of volume or sell side volume in the marketplace today with some strong reads in our breaths, right? These were steady and constant to the downside at all points of the day today, and that is telling you something, that the sellers are strong here. It's not, a liquidation break type selling. As the ADDs also sort of pair up with what we talked about here, high degrees of correlation, advanced decliners, you can see all negative, right? On Tuesday and into today on Wednesday, extremely bearish reads there. Definitely noteworthy. It's very rare that you see it outside of the lower bound here at minus 2,000. So it's noteworthy to see that we opened and spent some time there on Tuesday and also closed there today on Wednesday's session. Again, looking like the sellers definitely had a leg up across the entire market and not just in concentrated sectors of, the S&P 500 or whatever you prefer to look at. The tick, also same thing. Again, cumulative build here, getting worse and worse as the week goes on. Strong sell side activity here. All I'm getting at is it's not like this is liquidation break sort of material. It's long-term profit taking, people getting out of their longs saying, okay, we've been on a good ride, so be it. We're just going to start to trim a little bit. Or it's people starting to commit a little bit heavier to some short side activity, okay? So all things considered, it looks like we could go lower based on the internals. Again, keep in mind that SPY daily 50 SMA, that's sort of the saving grace if we were to start to see any sort of dead cat bounce, a little bit of reprieve of this selling into the end of the week. Let's move over to our sort of market profile, not sort of, this is the market profile. And what I want to point out here again is how, the skew of what happened today is more bearish than bullish, right? Look at where the point of control is on today's action, obviously towards the low end of the session. And whenever that happens, that just means that this is the fairest price to conduct business. This is where the most volume was transacted, and it sort of acts as a magnet, right? As that moves lower through time as opposed to higher, you can see that we had one here. Now this next one is here. It's basically just confirming for us that, okay, yes, it is fair that the bears are doing what they're doing. It's not like, the point of control was left up here and we closed down here. In an instance like that, you would expect a revisit of that point of control higher. But again, as it sits right now, it looks like we definitely could go lower here as the chart sits. I want to point out the poor structure, that gap that still remains below us in the S&Ps. If we have to scroll back quite some time to even get into it, but as we move back in time, again, this is that poor structure and why we talked about the gap filling being likely in the S&P 500. Look at these single prints here. This is extremely poor structure, and underneath that, we have, of course, this gap. This is the gap that we talked about on the S&P SPY chart, right? So this is why we ultimately think that there is a higher likelihood of us breaking this poor structure and moving lower before moving higher, which would be a violation of that daily 50 SMA on the SPY chart. Let's move back over and finish up the analysis here of the broad market with the Qs. Again, this is going to be very similar to what we discussed in the XLK, right? We are here sort of looking at one more gap to potentially fill underneath us, but after that, the neckline or shoulder line, if you will, of the inverted head and shoulders from in here, that would be my next up area of support should this gap fill from 315.80 down to about our 314.90, about $1 gap, right? So if that gap fills and we move lower, next anticipated target in the Qs would be down here around 310.75, 310.11, somewhere in that general area. Anything underneath, probably the 200 SMA after that before we get into the head of this pattern. Again, we've already broken that 50 SMA. We had that sort of snapback rebound. There's not as much poor structure here as there is in the S&Ps. So to me, it looks like there is some room to move lower, right? But if we do go higher, just like the S&Ps, how far into the prior day's range do we go? Do we go to the 50% mark, half back? Do we close in the upper third, lower third, so on and so forth? If you look at what's happened today, right? We essentially traded, if we just go from the open here, we traded to about 50% of the prior day's range, found some sellers, and then moved lower, right? So these are the things that you look at. How far into today's range do we go? Do we find sellers at the 50% mark? Do we never even make it to the 50% mark, consolidate down here? Those are all signs telling you that we could potentially go lower, right? If we go higher, obviously your target is here from the prior gap fill area, and today's high of day, you would want to keep that on your sort of watch, and 50 SMA after that. That would be one heck of a dead cat bounce after the serious selling momentum that we've seen. So probably not likely, but definitely not off the table into the end of the week. IWM, obviously, again, we use this one much more as a benchmark as opposed to something to actually trade. It's given up its daily support trend line just like the S&Ps. It's actually closed very strongly now below that 215, which was a critical area of support as noted by all these touches in here. So I wouldn't be surprised to see this go lower all the way to about our 207 quarter. If it goes lower than that, I would say these sets of lows are sort of coinciding. Give this about a 25-cent area of buffer. You could probably just draw this in differently as a box, do something like this, go from here. If we got the click, there we go. Just call this an area of support, right, from about there down to about 206. If we go lower, of course, the gap fill is the next target underneath from about, let's call it 199 quarter down to 197 3/4. Call it 200, right? That would be the psychological area that could provide some support. Again, is it likely that we get there in 2 days of trading? No, but given the serious sell-side activity momentum in the marketplace, it's not completely off the table. Overall, I would just say the IWM benchmark is bearish into the end of the week. Let's wrap up the video with those 4 trade ideas now. The first one is on WFC for Wells Fargo Company. And of course, this is sort of coinciding with what we talked about in our XLF analysis, whereas this is still right up at its all-time highs. If it were to go lower here, we have a 3-day flush point essentially right around that 45.50 mark. Let's go ahead and map that out. If we break here, this could catch up with the rest of the market to the downside, in which case first target would at least be the 20 SMA here on the daily time frame. Anything underneath that would probably be in here, closer to that 44 number, okay? So WFC, bearish trade idea in the financials. Next up, we have NCLH for the cruise lines, and this is another bearish trade idea. It's already started to show its hand, which is why I like it with the rest of the marketplace here. If we draw in a support trend line from here, if we got that click, there we go, just do something like this, you'll notice that we had, right, anchor, touch 1, 2, and then 3 looked like it was going to rebound on Tuesday's action, but now we've clearly and definitively broken that to the downside. The other sort of icing on the cake is we went right to this low as well. If we grab the other tool quickly, if we sort of flush this, 25.85, we'll call it the round figure there, it just makes up for a nice setup to come all the way down into our 24.31, most recent low after that. So watching NCLH for some more downside activity as well. HPQ is our next trade idea, and this one is sort of a bottom fishing play. If you look at this sort of uptrend here, extremely strong. We've started to cross that 50 SMA, and if we just pop in a trend line from our low and connect the dots here, again, we're using the low as the anchor from here, and this is touch 1. Always just use the swing out method, touch 1. We're right at it, right? 50 SMA support trend line. If there's going to be a dead cat bounce, it's probably likely going to happen now. So watching this for a potential move higher if there's any sort of reprieve in the QQQ and tech sector as a whole. And then the last trade idea is on ATVI. This is another bearish trade idea. If we zoom in here, again, already starting to flush these, this area of support. So we had a 3-day flush point in place. We've now closed below it. We have the 20 SMA above us, the 50 SMA above us. It looks good for some clearance to move slightly lower. The first target, in my opinion, would probably be somewhere in here. Right around that 90.83 mark, because we had prior support in here, a number of touches in here, this general area, and most recently here with a rejection there. If it goes lower, just target the 200 SMA, right? So as it sits, bearish trade idea here in Activision. The other thing that we can also do to sort of give us a little more credibility for this trade idea is if we go from here, if we got the click, thank you, Thinkorswim, and connect our resistance trend line. I mean, just look at this, right? We have touch or anchor, touch 1, and then touch 2, very, much a closer proximity. We always talk about that. The distance here being shorter, meaning a more likely area to potentially break, did not happen, right? We've pulled back. So that to me is a bearish setup now that we've closed underneath those critical moving averages. Okay, so those are the 4 trade ideas. That's my thoughts on the marketplace. If you enjoyed the video or learned anything new, feel free to let me know down below in the comments section. I wish you all a green rest of the trading week. Try to stay unbiased, try to think in terms of scenarios, and then react to those scenarios as opposed to trying to predict the direction of the marketplace. All right, I'm wrapping it up here. Have a green trading week all. I hope to see you in the Discord and in the weekly watch list on Sunday.